Welcome to TradeTheMBI.com. This is John. This report is for the 27th of August. Well, we talked about it on Thursday, the beginning of, what was looking to be decent buys with the separation of the green on the DOC, rising red. No indication that late in the month you had, a lot of free cash that was going to propel it, but that there wasn't any real resistance from shorts stopping it. And sure enough, that just allowed it to continue to go. But there were still buyers moving it, so that created the new highs. And of course, we're starting the pre-market here, and continuation of the same. You still don't have significant enough shorts. And now that you get into this area, once you get above like that 75 range, the pull towards the next level, the 2,900 in this case, is inexorable. But there's justification. You've got a growing economy with potential of achieving middle fours for growth. These are unprecedented numbers given the last decade or so. Inflation still not really a factor, and all those things combined, hard to make a case against the market continuing to move in a staggered upward range. Now, that doesn't mean we're not going to get pullbacks, of course. That's normal. In fact, we've seen the last couple of them that have been taking place, but each time we've been resetting with our shakeouts and starting a new run, and that began, same thing for the NQ, similar readings here. Wasn't a full reset, though, from the orange on a new power move, but what we had was the continued rising green, rising red, breaking into new zones, and as each time they break into a new zone, it's propelling things that much further. No objection to that. The euro obviously moving back. Now, see, we took some heat there when the euro was dipping below back into the normalized range, and then of course it pushed right back up, despite the fact that you still have these rumblings from Italy, and that really contesting euro dominance, demanding a certain amount of buys from ECB bonds, European bonds, because they were getting shortchanged for a little bit. And then a strange article about how when the PM met with Trump, that the U.S. was agreeing to buy Italian bonds, that's an interesting one. But it certainly is bolstered the euro in support of it. And here, of course, you still have this continued flight to quality. And again, we're getting back to this topic I mentioned before. The longer you have people moving towards these minimal yields compared to what the market is doing, all those that are responsible for maintaining, and what I'm referring to is fund managers and that matching S&P returns, could drive it even further. And that's what I always said, that would be the impetus for a move to 3,000 on the S&P, would be the fact that underperforming managers are going to have to drive things by buying additional to get caught up. So they'll be looking for dips to buy, and everyone will be saying, oh no, this is the one that's going to crash everything. It's like, no, that's just them seeing an opportunity to get something to help improve their numbers, particularly as we end the month here with the window dressing, summer ending, and everyone getting back to it. Should be active, especially going into an election that seems to be quite pivotal as far as whether the direction heads in the way of less regulation, more business, pro-growth, or we go into stagnation until the next presidential election. So a lot riding on the next couple of months. Oil maintaining this elevated level. It hasn't been enough yet to push inflation to crazy levels, but it's also at a sustained altitude that allows for significant growth in the industry, as well as employment, which those are all good things. So it's like that Goldilocks zone. It's not too hot, not too cold. Everything's just right. Gold, even though we've had this little burst from the rising shakeout here, this buy dip that developed right in there, it's not going to be, when you look at it from the broader context, we still haven't moved very far. But you're going to get these little bursts in that until people start to recognize a significant change. And like I've said, the reality is with the cryptocurrencies and that, big move from gold has been back into oil as far as a liquid inflationary hedge, regardless of its commodity nature. I think you get a little bit of a double play on those. Will things start shifting back to gold? Don't quite see that in the readings just yet. Doesn't mean it won't happen. It's just we're not there. So Friday's action was kind of boring. We ended up with a series of positive extremes after having dipped to our lows from the previous setups. We ended up with some fairly decent buys all the way along. And once it was about the 50%, it was clear. And then we got the gold. Started to get a couple of little clusters, but the problem was is that they all filled relatively quickly right after them happening with just short tail bars. So it's just a matter of dip down, fill it, and then move on. Same thing happened with this last set, and then it wasn't until the breakout move right here, and this becomes, so it's easy enough to just go there. We just make a new parallel right there, and can slide it right up there, and that becomes the new full pullback. Now, obviously, we've already had in-between ones, which came back right from down here and filled in the range all the way going up to it. So it just leaves the last of the two from there to get filled. But we maintained the gold throughout there, and then we had another gold up near the highs, and that propelled us obviously to these new breakout highs, and of course positive extremes. So we're going to have another setup from this one. And while this happens in pre-market, we may see a test back of this during the day, which would not be too shocking unless things just get continued carried away since but there aren't really that many shorts to really drive a mass pump, so this is going to be one of those little steady, and they use the after hours where there's low liquidity in that because it's easy to then pump things up. So you have to bear that in mind, and when the big boys come back in there, they usually fill it back in and make sure that it can actually sustain that value. But solid from DOC. Cyan under red is always buy. It was pretty clean. You ended up with the opening of the mouth that took place right about there. There was nothing wrong with that one other than the fact that you didn't have green hitting back below red until, well, right over here. And that was just for a brief moment, and so we've kind of fluctuated along that. But even when it happened, you'll know we did make a low right back down to the ABM yellow, and then just held across there. So all in all, it's a really good action, and the ranges have been really good. No complaining. That volatility that we expected for August definitely fulfilled itself, and can't complain. I think it's only going to get bigger as September starts, so I don't think that we're anywhere near moving away from bigger swings. I think that's just built in to the situation, because there's going to have to be some mean reversion back and forth just to support the move, and I think that will add actually more validity to it, because that justifies where things have been headed, and certainly the economy has done that. And of course, obviously, the next set of earnings, when they come out, will certainly be pivotal as to whether or not things are accelerating or leveling off at any point, which would not be a bad thing, because while some people might say a slowing of things would be weakening, it actually would be beneficial from preventing bottlenecks and strong inflationary pressures. And so as long as that doesn't exist as far as the labor participation and finding new workers, we won't get a dramatic squeeze in commodities, which is really what everybody's watching, and we have to watch it as well, because it becomes significant as it relates to market risk. So we'll keep an eye on it, and I'll keep posting on the Skype chat as warranted. Trade well.